Here we go, money talk.
Here comes the money.
Home buying terminology is basically its own language. We have a glossary, we have an almanac full of terms, something hopefully you can reference if you ever have any questions and I'm not available. All of these terms are gonna be alphabetically arranged and not as far as the timeline and the home buying process goes. We want to do everything that we can to make sure that you're completely educated on the home buying process. We want to make sure that you're smarter than the agent on the other side. Appraisal. The appraisal is how much the property you're shopping for is actually worth. The mortgage company that you use will actually send a person called an appraiser to go do the appraisal on the property. The number that they generate is how much that lender is going to actually give you to borrow to purchase that property. If you put an offer in on a property for $500,000, the appraiser will go out, it'll look at the comps, it'll look at the property, and it'll say if it's worth $500,000 or not. Your appraiser, your lender, is basically your partner. Appraisal contingency. The appraisal contingency is a clause that you put into a contract. So it means that if you put an offer in for $500,000 and the property comes back at $490,000, like it's only worth $490, but your offer's for $500, the appraisal contingency is a clause that says, hey, look, we aren't gonna buy this property because it's not worth what we're offering. The bank's only gonna give you $490. If you don't have that $10,000 in your pocket to pay the difference, or you can't come to terms with the seller, this clause actually allows the buyer to back out as is. Now we see as is everywhere. Seller selling as is. This just means that the seller's not going to make any improvements or changes to the property. Majority of the times, it does mean that they will lower their price. They're just not gonna fix anything. That's what you want anyway. Backup offer. So let's just say that you like a property and you want to put an offer in on the property, but the seller accepts another offer. As a buyer, you can put a runner-up offer or a backup offer to be in the waiting room. So if that deal falls apart, your offer can then be selected. It can be negotiated just like any other offer. However, it's not technically accepted unless the other offer falls through. We know that 33% of all deals fall through, so it's good to put a backup offer in, but you don't ever want to rely on it. Blind offer. This is basically putting an offer in a property that you haven't seen yet. This is typically used whenever you're relocating, or it's a really competitive market, or there's a tenant in place. It just means that you didn't go see the property, you just submitted an offer. See what happens. Buyer and listing agents. Now these are just your licensed real estate agents that are representing the buyer. Listing agent is representing the seller. Like in the court of law, you have one side and the other. The buyer's agent will help the buyer. If you were my seller, I'd be helping you, the seller. Buyer's agents help negotiate terms, submit offers, show properties, handle scheduling, closing, all that good stuff. Cash reserve. It's the amount of money that you actually need to have on hand or after close. That's gonna be in a savings account too. If you were purchasing a second property in Florida, they're gonna have its own down payment, but they're gonna require you to have a cash reserve of 1 year, sometimes 1 year of mortgage payments. That's how you get it approved. Closing. Closing is the last dance. It's where everybody gets together, they give each other the documents, agents meet, buyers, sellers meet, closing attorneys there, everybody sits at a table, they sign documents, they pass checks, you get your keys if you're the buyer, the seller gets their checks. That's whenever you actually become the owner of the property. Typically a closing happens 30 days after you have an offer accepted. Closing settlement statement, and this is just an itemized list of all the costs that are included in the buying and selling of a property. Sometimes it's called a HUD, and a lot of people call it closing disclosure form, which closing disclosure. This is gonna be the document that explains all the costs, the mortgage insurance, monthly payments, your closing costs. You should typically get it between 48 and 72 hours before closing. Gives everybody the opportunity to review it, make sure it's all correct. Closing costs. These are all the costs that are associated with buying a property if you're the buyer. And these are all the costs that are associated with selling the property if you're the seller. They don't actually include the actual price of the property. So if you were the buyer, your closing costs would be down payment for the loan, loan origination, and any other fees and services provided by the closing attorney, etc., etc. Credit report. This is going to be a list of information about all the loans, credit, bills, payment history that you have. Lenders pull credit reports for buyers. It'll have your credit score on it, and it'll tell the lender or the mortgage company, the bank, whomever is giving you these funds, if you are approved for the loan. Common area. So whenever you're purchasing a townhome, condo, sometimes properties in HOAs, common area is basically where you don't individually own it, kind of like a median, play area, parking, laundry rooms, courtyards. Comparative market analysis, or CMA. This is a tool that real estate agents use. If you're representing a buyer, if an agent's representing a buyer, they give a buyer a CMA just to make sure that buyer is making actually a sound decision and submitting a decent offer. They're not going too low, they're not going too high. CMA on the sell side is basically telling the seller where they should be priced at if they want to be competitive in a market. And it has a list of all the most recent sales, all the properties that haven't sold, all the properties that failed to sell, tells you how long they were on the market for, tells you all the specs on it. Comps, it's short for comparables, and it is other homes that have sold that are similar to the property that you're running the comps on. The appraiser, for the appraisal, which we went over earlier, they run the comps to make sure that the appraiser actually run comps too. Contingency. Contingency is a clause that gives you the opportunity to back out for whatever reason. So earlier we discussed the appraisal contingency. You were able to back out if the property didn't appraise. There's due diligence, there's inspection contingencies where if the property doesn't pass an inspection, you can back out. Conventional loan. This is a loan that's not insured by the government. Covenants, conditions, and restrictions, aka CC&Rs. And these are going to be the rules and regulations that an HOA has for a housing community. Counteroffer. It is a response to initial offer. So if a buyer submits an offer for $500,000, the seller submits a counteroffer, $550,000. It is a very common occurrence, and I always suggest my sellers submit a counter offer if they don't get the number that they're looking for. Days on market, or DOM, that's simply how many days that the property's been up for sale on the internet. It is a very important indicator. Debt to income ratio, DTI. This is just a comparison of how much monthly income you have versus how many monthly bills you have to pay. We're talking car payments, school loans, rent, other mortgages, etc., etc. Mortgage lenders will use this ratio to basically determine if you can actually pay them back. And it's typically expressed as a percentage. Depreciation. So when your house starts to lose its value, wear and tear, age, goddamn tree falls through the garage. Deed, it's a document that you actually get whenever you buy a house. Default. Default is whenever you are not making regular payments or you're failing to make your payments. Typically leads to foreclosure. Pay your bills. Disclosure, it's whenever a homeowner actually tells a buyer any defects about the property, leaky basement, lead paint, chip paint, roof claim, other important problems with the structure. Anything that the seller is aware of, they need to let you know. However, I always suggest my buyers beware. Just to the best of their knowledge, they could always forget. Always get your inspections, buyers. Discount point. This is when you pay money to your mortgage company up front to reduce your overall interest rate for your loan. One discount point, one interest rate. Due diligence. It's a period of time that's written into the purchase agreement, the offer that a buyer submits to the seller, where the buyer has the opportunity to do the inspection on the property, and it also gives the buyer a window to not only inspect the property, but to back out for whatever reason. Earnest money deposit, or a deposit. This is your skin in the game. This is the money a buyer puts up with their offer. They risk losing it if they back out outside of the due diligence window or outside of the contingencies. So 9 times out of 10, you'll see 1% of the offer price, $500,000, put up $5,000. You put up whatever you want to, but it shows the seller that you're a serious buyer whenever you put up 1%. Now, you put this up at the very beginning of the transaction and it goes towards the overall purchase of a property. If it's a $500,000 property, you put up $5,000, now it's a $495,000 property at the end of the day. how much you owe. The earnest money goes towards your down payment for the most part. Equity is a ratio that shows or compares how much you owe on a mortgage versus what the property is worth. If the property is worth $500,000 and you have $400,000 of equity, that means you have $100,000 left to pay on your loan. Equity increases as you pay your bill. So you give $1,000, your equity increases $1,000. Escrow is an account where your down payment and deposit or other deposits are stored until close. FHA loans are loans that are insured by the Federal Housing Agency, FHA, Federal Housing Authority. Foreclosure, it's the legal proceeding whenever you fail to make your mortgage payments. The bank got your house. For sale by owner, or FSBO, it just means that a seller is trying to sell their property themselves. Typically they fail to do so, or they have unrealistic expectations. But for sale by owner is an owner who's trying to sell their own property without representation. HOA, or homeowner association, it is basically the authority that'll fine you $50 for leaving your trash can at the road, or if you don't cut your grass on time, they'll fine you. But they're an authority over the subdivision, complex, condo, townhome community, housing community. They're the authority that basically tells you, hey man, pick that stuff up. Keep the neighborhood clean. There's usually a fee that you pay for an HOA. Inspection is whenever a buyer hires a certified licensed professional to come into the property, inspect that son bitch from bottom to the top, from the foundation to the rooftop. They look at every little thing about it. It's a third-party company, so it's, I mean, you're paying for them, but they take their job very seriously. They're gonna give you a full PDF, 50 pages, all red checked, red marked up. Looks like a failing paper. And it's gonna tell you everything from cracked paint to anything as serious as structural damage, roof damage, HVAC damage, lien. Basically, if a seller has a loan out and they put their house as collateral, that seller has a lien on the property. This is why you get title companies to make sure that all liens are taken care of before closing. Loan contingency. Loan contingency is basically a piece of paper that tells the seller, hey, if this buyer doesn't get this money, if this buyer does not get approved for a loan, they can't buy it. They won't be held responsible for buying it. Loan to value ratio, or LTV. It's a number that compares the loan value to the appraised value. Typically it's a percentage. Ask your lender. Market value. Market value is basically how much your house is valued at based on the appraised value. Mortgage. Mortgage is a legal document that explains how much you owe on the property. Mortgage broker. It's somebody who pairs you up with a lender, and there's usually a fee, a little finder's fee if you will, but they're not the people, or typically aren't the people who give you the loan. They just broker the deal. MLS, or multiple listing service. It's the real estate agent Zillow or Trulia or realtor.com. It's a database of all the property listings that are out there. Every agent, everybody's phone numbers, tax records. It's our cheat code. This is where we pull the comps from. This is all the information that we use to get your home's value or make sure a buyer's making the best offer. It's the offer you make on the house. Paperwork's typically done on a purchase and sell agreement. It's about a 7 to 10 page document where you only fill out a handful of things. Everything else is legal jargon explaining what you just filled out. So if you ever have any questions about an offer and you feel like you don't know, there's gonna be exactly an explanation of what you're signing somewhere around where you're signing it, or at the very back of it, just depending on what state you're in. Origination fee. This is part of your closing costs. It's the lender just getting broken off. It's a fee that the mortgage company tax on to make sure you get your money, everything's taken care of for you as far as the financings go. A pre-approval, very different from a pre-qualification. Pre-qualification is basically a lender saying, I think he's gonna pass based off of what he said. If he's honest, yeah. Pre-approval document from a lender is just as good as cash. It says Scott is definitely approved for $500,000. Here you go. I always suggest buyers get pre-approved before we even start looking at properties, because we know for sure that your financing won't fall through and you are pre-approved to borrow this amount of money. Prepayment penalty. Prepayment penalty is basically a penalty fee that you have to pay if you pay off your mortgage. It's always good if you're ever gonna pay off your lender, you just check with them to see what that prepayment penalty is. Pre-qualification, just what I spoke about, a lot different than the actual pre-approval. Pre-qualification is a lender that asks you a few questions and then they're saying, oh, based off of what this person said to me before me looking at bank statements, running credit report and all this, yeah, they qualify based if everything they say is true. Principal. Principal is how much money is on the loan minus the interest. So it's what you're borrowing. PMI, private mortgage insurance. It's if you have a down payment less than 20%, they do that just to protect themselves. Proof of funds. Proof of funds is the cash buyer's version of a pre-approval. Sometimes people call pre-approvals proof of funds. Proof of fund is basically a seller saying, hey, we gotta see where you can actually afford this. We're not gonna accept an offer without proof of funds. Short sale, it's whenever a seller tries to sell a property for less than what they owe. And it's typically a long, drawn out thing. It's not a short sale. It's like, we're just not gonna give you as much money short. I'm short. Title. Title indicates who actually owns the property. Title insurance, which you always want. You don't have to get it, but you want it. You absolutely want it. Because if you had a terrible closing attorney, title insurance protects you in case something from 1818, Joe Bob McCaffrey, comes back and he's like, hey, this is my father's land. You have title insurance to make sure that you don't have to give up your property. It protects you against any unknown debts or liens on the property. Title search. Title search is something that a closing attorney does to make sure that the title is clear. They're looking at previous sales and purchases. They're looking at taxes. They're looking at other debts or liens on the property. A VA loan, and that's a mortgage that's actually guaranteed by the Veteran Affairs Department of Veteran Affairs. It's for veterans, thank you for your service, both active and not active, retired, low to no down payments, and very competitive interest rates and fees. Underwriting, it's basically where the mortgage company sends all of your information to they make a joke, to the troll in the tower, and they're basically having a risk assessment. The underwriter is making sure you're a good investment. Upfront costs, and these are gonna be costs that a buyer typically has to pay before closing, upfront costs. These include appraisal fee, credit report, hazard insurance, flood insurance, origination charges, service charges, termite, radon inspections, HVAC inspections, roof inspections, anything that you pay for before closing costs is an upfront cost.
Dollar, 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 ching, ching.